Hello and welcome to our webinar on how to stand out in a crowded M&A market. My name is Paul Dondos. I'm MD in London. I run our global buy-side market intelligence strategic advisory practices. I'm joined by my three colleagues, one from Boston, Greg Fincke, MD, co-head of our management consulting and IT services sector in North America, Jerome Glynn-Smith in London, head of our management consulting and IT services sector in Europe, and Sylvain Masson in Singapore, who is a director in our APAC practice. Just some housekeeping before we move on to the presentation. Please do engage in the chat panel, get to know fellow participants, and also feel free to leave questions in the questions panel as well. We'll try to get onto those. We have some pre-submitted questions and we'll address all of those at the end of the slides. So with that, let's move into the presentation. So first question is, why are we running this webinar? Who are we? What is this for? So Equitec, I'll come into a bit more detail on the next slide, helps owners and partners of knowledge economy firms to grow, acquire, and realize equity value. We have been bullish since the pandemic arrived and about the prospects of M&A in our sector. In fact, a year ago, just over a year ago, May 2020, we were giving a webinar on the advantages of realizing equity value now. At that time, forecasting that the scarcity of assets that was a great advantage at the time for business owners seeking to look at an equity event was something that would not last forever. And here we are, a year later, looking at a market with record volumes, values of M&A, and some of the challenges that presents, as well as opportunities for owners and partners in that scenario. So what is this perfect storm that we described that is driving this boom in deals and investments? We'll talk through that, and we'll talk through the challenges that are inevitable with this level of activity. So hopefully through this discussion, we will help you to understand where these challenges and opportunities came from and help you to navigate a path through them. Word or two on Equitec. So we are a global M&A boutique that advises specifically firms that are knowledge economy firms. That means businesses that sell knowledge and expertise, leveraging people, IP, and software to deliver that. That means consulting businesses, tech-enabled services businesses, software businesses, SaaS businesses. We've been doing that for over 15 years exclusively. We are a bulge bracket boutique, which means that all 70 of us comprise, as well as that niche focus, a full range of banking services from sell-side, buy-side, strategic advisory, and market intelligence. And one other point on Equitec, we have always taken a long-term view with clients working to assess trajectories towards transactions and staying with them in some cases for a number of years. We've transacted coming up for 120 firms in the knowledge economy. So what is this perfect storm that the knowledge economy finds itself in? Three key elements here. One of those is the ongoing march of the innovation megatrend. What does that mean? That is innovation-driven trends that go well beyond technology and those buzzwords that you see there on the left, right across the global economy, global activity, through changes, innovation, policy, health, finance, the way enterprises are run, business models, markets. That is a relentless driver of change. And the businesses that we serve, the knowledge economy services firms, are there to provide services, to manage, to exploit, to defend in the face of these changes, these rapid changes. That hasn't stopped. The level of disruption that's been going on in the last 15, 18 months has only accelerated that. And the second of the drivers is, which existed before the pandemic and has just increased throughout, is capital, and that is dry powder in the hands of private equity, the trillions that have amassed and continue to amass as funds flow into private capital, and stock market valuations for corporates and corporate balance sheets that are extremely strong and therefore can support the levels of M&A that we're currently seeing. Some of those elements around the capital are of particular interest. You've got shareholder demands driving businesses to acquire their way to maintain growth. And you have the ongoing war on talent, businesses, again, struggling to find the right talent to be able to service the level of change that is coming through innovation. So they have to acquire them. And that's been the case before, continues to be the case now, and will continue to be the case. You see favorable tax regimes and business owners trying to move in advance of changes to those regimes, therefore triggering transactions. And you have buyers and investors that are moving between brackets. So convergence plays that you can see on the left as well as part of the innovation megatrends. But you also have buyers that are looking at smaller or larger assets in an effort to be competitive in their inorganic growth strategies. So different buyers coming in from different areas of the economy to find combinations that can drive shareholder value. And in that competitive scenario, buyers having to move up or down size brackets as well to be able to compete as well. At the bottom there, you see the pandemic, some of the facts of the pandemic that has actually been a catalyst to M&A activity in our sector. The trillions of capital relief that were pumped into the economy throughout, obviously propping up that the institutional drivers there. But we also have the changes of business models that have come through necessity, remote working. You have the pent-up demands that has been released in 2021 as the businesses, the funds that were triaging assets in the earlier stage of the pandemic came forward and reenacted their M&A strategies. And you can see that playing out in the levels and volumes of transactions that are going on at the moment. We have buyers back at the table, and you have sellers as well, seeing what's going on in the market, seeing the valuations being achieved, and therefore it's a chain reaction, which it also supports those levels of activity. So one or two quotes on the right there, you can see those are anecdotes. If we move on to the next slide, we can see a bit more data as well to support that. Three areas here, three items of data that are proprietary. So on the left-hand side there is a word cloud that's built up out of the buyer conversations that we Equitec have. We've had over 250 of those in the 5 months, January to May. That means 2 or 3 a day. And in those conversations with buyers, specifically of firms, knowledge economy firms, investors, we record what those preferences are. And you can see all of those and how they converge around some of the key areas of focus. And then in the middle there, you can see a basket of public companies that are knowledge economy firms that we track. And you can see on the left there that the axis is showing the EBITDA multiples of those public companies and how that has progressed over a longer term trend since 2016 as the economy has grown more comfortable with investment in people, IP, services, businesses. And also you can see the dip COVID and the correction that's happened and then been translated through the V back on track and rising. We're looking at average multiples of 22 times. So there's quite a range of stocks in there. Some of them are enterprise software, as well as the services, consulting, technical services firms as well, all relevant businesses and being driven on by these innovation trends and capital. And finally, on the right-hand side, you can see the deal volumes. Just the point here is that gray, thick gray line is the volumes of transactions in this year. As expected, they're beating 2020, but they're also beating 2019. We've got significantly higher amounts of transactions going on. So this is the proprietary data behind those anecdotal and theoretical views of the market. And so we're seeing it firsthand. Now, before I hand over to my colleague Greg Fincke, as I said, there are, with these opportunities, with this amount of heat in the market, certain challenges, and it's to those that we now.
Thanks, Paul. Certainly an exciting market backdrop for all of us in the M&A profession, but that the market heat, the activity we're seeing in the market does create some challenges. So we're seeing buyers feel that it's very hard to compete in competitive auction processes. So the output of that market sentiment is increased direct sourcing. So we're seeing buyers, an uptick of buyers going directly to companies, to potentially interesting targets. And what that's causing as a knock-on effect is a lot of our sell-side clients, owners, are feeling bombarded with inbound interest and trying to understand, what's real, and balancing, not leaving an opportunity on the table with running their business, growing their business. So I think all participants are seeing sort of outputs of a hot market, high valuation, and it's just causing a lot of activity and a lot of noise. The other thing we're seeing is high volume of transactions in the market, and means buyers have capacity constraints. We're hearing more and more from corp dev teams that they're at their max. They just can't look at any more transactions. That's causing deal sizes to go up. So focusing on bigger deals that what they call move the needle. So these are kind of some of the impacts that are not necessarily 100% positive, but are coming out of the increased market activity. We have some concerns around future financial risks in particular. It leaves our clients in a tough position where there's an active hot market, it requires navigating, and there's some potential future risks. Move on to the next slide, and we can share sort of our opinion on what we think about that. We think there's still time. So while there are some dark clouds, mostly around potential financial implications, we fundamentally believe the market trends still have legs. So we don't advise our clients to sort of move into a panic sell. However, there will be a correction at some point. We don't know exactly when it will be or what the trigger is, but when we sort of net out the risk of a market correction, some of those headwinds against the tailwinds we're seeing, we are bullish on the future. And for American business owners on the webinar, I think there is a caveat to that. If you're around tax leakage, if you're contemplating a deal in Q4 of 21 or H1 of 22 on a net cash basis, it's probably better to complete a transaction in Q4 relative to where the policy is going to end up on capital gains tax. I think it probably will not be retroactive and probably not as drastic of a hike as initially proposed. So we do want to sort of moderate some of those concerns, but it is an important consideration. If we move on to slide 8, touch on some key takeaways. So, if you're ready, it's never been a better time to run a competitive process because valuations are at all-time highs. So, in the deals we're running, we're seeing our multiples for our clients exceed historical levels consistently. If you have a credible inbound, work with your advisor to understand valuation required to exit, and then work with the buyer to build an investment case. So we're doing a fair amount of work here where just setting a number for our clients and then helping the buyer to build the case to get to that number. And then also, if you're fielding multiple inbounds, really rely on your advisor to qualify interest and communicate valuation expectations so you can focus on running your business and only spend time with qualified buyers that meet your criteria. So we're seeing a number of these scenarios unfold, and they take some navigating. And I'd say from our perspective, we are structuring far more bespoke M&A processes that consider sort of all of these dynamics in the market around buyer interest and creating competitive tension and maximizing value and hitting owner valuation expectations. So it's certainly an interesting time to be in M&A. And with that, I'll turn it over to my colleague, Sylvain.
Yeah, thank you, Greg. So as you just explained, depending on how motivated an investor is, the value differ quite significantly. Owner, you need to make sure you're positioning the company in a way that will make you stand out vis-a-vis your preferred group of investors. So a couple of points to be highlighted. So as discussed earlier, the market is currently very hot in the knowledge economy sector, with every party trying to beat their potential competitors by acquiring the most valuable assets. So it's good news if you're part of these highly visible and strategic deals, because it means there will be competition driving the prices up. However, if you're part of the smaller mid-sized target, it might be more challenging to attract buyer interest, especially since most buyers might not have the bandwidth to complete several deals at the same time and will most likely focus on those larger opportunities. So how do you make sure your transaction will be successful? First, it will be by following a structured process. A transaction event should be treated as a project in itself. Then it will be by making sure you speak to the right buyers. Good knowledge of the buyer landscape is fundamental to optimize the transaction process. And each company will attract different types of buyers coming either from similar or adjacent sectors. That's something we see quite a lot these days. And for each group of buyers, you will have to identify the strategic rationale and the business synergies, which will make you highly attractive. So this should be properly reflected in the investment highlights, which is usually presented in a teaser. That initial code name and documents investors will review to assess their interest in an opportunity. So you need to keep in mind that investors will usually spend no more than 10 minutes to assess their initial interest. So you need to make sure the message is compelling. Specific point on financial investors, we mentioned that there were a lot of dry powder this way. So they are very active in the space, that's true. And they are a good alternative to strategic investor. However, you need to make sure the investment case is extensive with a clear emphasis on your key differentiators, your growth strategy, your potential to scale, and to capture significant market share in the market you're operating. All in all, what you want is to create a bit of buzz in the market, to create some competitive tension, which will both drive the valuations up and increase your chance of a successful outcome. Couple of advice to keep in mind. The first one will be to be realistic about your expectations in terms of valuation. Even though we are on an all-time high, there are still some differences between the unicorn, and depending on your size, they might have some differences. So you need to be aware of what you can reasonably achieve and what's the upside potential. You also need to be realistic about the type of buyers, which will be more aligned with your vision of the business. Indeed, aspects like culture fit and alignment on growth strategy are important points to consider, especially since most of the deals will have an earn-out or deferred component. In this sector, it's very, very unlikely that you will get 100% of the cash up front and will be able to live and play golf. Most likely, you will have to stay and continue to develop the company for a period of 3 to 5 years, depending on the type of investor. Something to be avoided as well will be to rush into a transaction or to answer unsolicited offers if you're not completely ready. And in this respect, I will let Jérôme take over and explain what the preparation process is.
Thanks, Sylvain, for setting that up. So I think from understanding the market dynamics, understanding the valuation, understanding the buyer situation, it leads to probably a last piece, which is to be ready to transact. I think the situation in the market is a situation of a lot of dry powder, a lot of liquidity in the private equity side, a lot of intent to acquire capability on the trade side. And that is defined in a certain time frame and certain timing, where people need to deliver on transactions in a certain time frame. Will it be before half year, before year end, before next summer? There is a time frame. And so in this endeavor that global investors and global buyers have to prioritize which are the deals that I can do in this liquidity rich, numerous sellers, numerous buyers market, is which deals can I actually act upon? And the deals that can be acted upon are the deals that are well prepared for. So effectively, preparation comes through a level of cultural preparation and organizational preparation. Is the business culturally and organizationally aligned towards a liquidity event? Are the people incentivized towards a liquidity event? Is there internal communication around a liquidity event? And are there processes that are set to maximize the outcome of a liquidity event? And then from a transaction perspective, there are 4 pieces of advice down the middle column there that we will normally give to people that we discuss these options with, are that we need an aligned, you need to be aligned in what you want to do. The worst thing that can happen is to go into a process where buyers and investors discover during the process a lack of alignment at shareholder level. So that level of preparation to have one message is a key element of success. The second piece is related to positioning the transaction team and having a transaction team in your business that you're able to present to investors and acquirers. So in some situations, shareholders will be aware of a process, but shareholders are not the entire business. They will have a management team, and being able to position that management team and looping that management team in to transaction discussions is something that takes time and something that is good to be prepared for. The third piece of advice that we will give is to be data obsessed. One of the gaps that we see in the knowledge economy versus more sort of product driven SaaS models is that the SaaS people from the SaaS world are completely data obsessed. The people in the knowledge economy that succeed are also data obsessed. Being able to have harmonized, consolidated financial, HR, and legal data at a group level, ready on a monthly basis and ready to be poked around, effectively gives you power in processes and enables to entertain multiple discussions and to run a smooth Q&A process for you to be able to instill the momentum in a transaction as opposed to take the momentum from buyers and investors. The last piece of advice that we give in terms of being transaction ready is to prepare to engage with the market. So it shouldn't be that people discover that you have a very exciting and valuable business at the time when you go to market. The idea is long time before, probably in a period, in a run up to about 12 months before actually being in the market, you've met people and you know people, and people are actually waiting for the business to come to market to be able to act on it and act quickly on it. And so these 4 elements are what makes you an actionable asset for buyers. And in this environment where buyers are looking to execute on M&A strategies and investment strategies, the more executable assets will be the assets that will trade. So that's, I think, an important point to close this out before we move on to the questions. So thanks for moving on to the questions piece. So I think what we've done here is we've picked out a few questions that were submitted before the webinar by a few of you, I'm going to pick some of them here and maybe sort of distribute throughout the team, depending on particular relevance. I'll go for the first question, which is quite interesting. So have ways to value tech companies changed post-COVID? So what I'd say on this point is that no, I think valuation methodologies per se are similar. The shift in valuation has really come from the growth in the space and the requirement to fund that growth and the requirement to acquire capabilities that have pent-up demand through enterprise digital transformation. So the shift in valuation that we've seen going upwards from pre-COVID versus post-COVID is more driven by demand and growth, as opposed to changing the sort of methodologies for valuation per se. What we have seen post-COVID in terms of differences is that some adjustments are being accepted for 2020 that is being seen as an abnormal year in terms of EBITDA position, in terms of EBITDA adjustments, in terms of cash and cash collections and cycles of cash. But fundamentally, the valuation methodologies are the same. It's that growth and demand are different, and that's been pushing valuations up with all that liquidity, pushing sort of competitive processes to the higher ends of valuation. Moving to maybe another question, I'll take the last question on this on value enhancement. So when and which is the appropriate stage for a company to look at inorganic growth? So what I'll do on this one, maybe I'll call on you, Sylvain, to touch upon that.
Yep. Thank you, Jérôme. So doing some Bolton acquisition might be a very good idea. That's a short answer. Indeed, it might be a relatively low risk and potential low cost acquisition, which can accelerate your growth strategy. Also, another advantage would be that there is a mechanical creation of shareholder value by acquiring some smaller company on the basis of a multiple that will be lower than the multiple likely to apply at the exit event. You need also, before considering that type of move, to look at the potential synergies with these specific targets in terms of new clients, services, sector, and geographies. Couple of caveats though, it always seems to be a great idea on paper, but in reality, it's more difficult to achieve. Indeed, small firms may end up being proportionally expensive, not in terms of purchase consideration, but in terms of time and energy spent on acquisition and integration. That's important. Also, the integration needs to happen in order to be considered positively by any potential investor. And this takes time, meaning if you're looking yourself for an exit event, it would most likely delay the process until this integration has been achieved. And such integration can often prove to be trickier than expected and may affect the enterprise culture without delivering all the expected synergies. So here's advice is, yes, you can consider inorganic growth basically at any point in time in your journey, but you need to be very careful about the asset you're considering, really looking at pros and cons. And the best ideas is when it's company you already know, you already trust, to avoid the different caveats I just spoke about.
Thanks, Sylvain. So I guess in short, very good idea to get it right, and it's something that's envisageable at pretty much any scale, really. So thanks. Moving maybe to another category here on specific markets, we have a question on interest in regional economies coming from Miguel Felder and our friends at Praxia in Argentina. Greg, you're I guess representing the Americas on this. Do you want to take that question about is there interest and under what conditions in IT businesses with regional exposure? And I think this question is particularly geared towards LATAM.
Yeah, thank you, Jerome. We're seeing significant interest in nearshoring capabilities in LATAM within the IT services market. So in that business case, there's absolutely interest. On the other side, we recently advised a company out of Colombia, Sophos, that was delivering, and their clients were in LATAM, so very much a LATAM-oriented business. A successful transaction. They sold to a global private equity, Advent. I think if LATAM is your focus of your client base and your delivery base, there are opportunities to exit, and there is interest. I'll caveat that by the scale criteria goes up. We see the interest really the company really needs to have achieved a critical mass to attract attention. We see it as harder for smaller companies where their exposure is 100% LATAM to attract buyer attention.
Thanks, Greg. That's great. So I was just reading through the questions here and picking on a question that's probably more from the buyer's side that I thought be interesting to pick on, related to when you're a buyer, how do you keep this M&A affordable in this market? So one of the questions here is how do you keep exit multiples down in overheated sectors? I think Paul, you spend a lot of time with buyers talking through this stuff. What would be your take on that?
Well, the simple answer is not to be reactive. If you wait in this environment, the things that are going to come across your desk, while they might be great assets, will have been prepared for probably competitive auctions, and you're going to be seeing those exit multiples at the levels that they're running at the moment. If you want to mitigate that, you can do that, I guess, in two thematic ways. One is to actually aim to achieve lower multiples, and the other is actually to be more comfortable with the multiples that there are and have a better business case and look to a more solid integration, less risk in post the transaction. For both of those, it pays to be systematic, take an approach, to be programmatic, and take a long-term view. At this stage, it may be late to be able to activate that, but probably not. If you want to make an acquisition still in 2021, you can scan through a market and really understand the assets and at least have built the confidence that you've seen all the assets that are relevant to your strategy, and maybe find assets that aren't drawing too much attention in this market and therefore achieve a better multiple, but at the very least be able to double down, as it were, on the right asset, knowing that it has that you've seen everything in the context, and therefore you're able to do so with confidence, right? Ideally, you would have done that already, or ideally you're looking more longer term, and that programmatic approach will lead you into relationships with potential targets that will also give you more confidence and enable a transaction potentially at a better multiple with a better risk profile, better structure to it, that will be better than jumping into the situation now reactively on the basis of businesses that are coming to market through processes. Thanks,
Paul. That's great. We've got another few minutes to go. There's a theme going through these questions around when does the market slow down, and I might pick on that as the last one, and then we have a question that's come through the Q&A, the live Q&A, which is about earnout, and the two questions are similar, sort of related to what earnouts look like. Maybe we touch upon that one first. So, Greg, it might be worth you picking up on this one. The first question is 3 to 5 years horizon for the earnout still within expectation. So there's a question about how long the earnouts are. And then there's another question, which is what types of ratios are you seeing between upfront cash and deferred consideration? So effectively the earnouts. It's about the length of the earnout and the proportion of the earnout. What have you been seeing in the market?
Yeah, when we advise our clients and to set expectations, 3 years is generally a safe expectation, and then sort of plus or minus, maybe 2, maybe 4, 5. We would think would be excessive in this market. So I think a good number to sort of plan for is 3 years, and then depending on there are a whole list of reasons why it might be shorter or longer. But 3 years is a good benchmark and a good starting position. In terms of the percentages of cash versus earnout, 60 to 70% is a good metric to sort of anchor to in terms of cash up front. Again, could be higher. We're not seeing much below 60%, but it's a good benchmark to be thinking about. When we're seeing earnouts evolve, so 4 or 5 years ago, there were majority around like EBITDA based earnouts. We're seeing more top of the P&L earnouts, revenue, just hitting top line targets, and more we're seeing retention based earnouts. So vast majority of our clients are hitting their earnouts, and they're meant to be achievable. But I think from a ratio perspective, it's good to think about 60 to 70%. In cases it can go higher, but so that's a good anchor.
That's great, Greg. Thanks. I think it's a great thing to say that a lot of our clients are making their earnouts, and it's not a bonus. It's part of your equity value, and that's I think that's definitely a core message. So we've got a few more minutes to go before, unfortunately, we run out of time. I thought I'd pick on one question related to this theme that when does the cycle slow down? So there's a question there in the valuation piece coming from Alexandra and our friends at Efeso Consulting, that when are you expecting M&A activities to slow down? So I think the answer to that is that we're not. The cycle from a valuation perspective is high, and we could see that stabilizing. There is a fundamental reason backing that, though, which is the growth that's been exacerbated in these areas of digital transformation and consulting by COVID and the pandemic and the lockdown. And the digital transformation spend over a number of years is now being anticipated and crammed into this period of time. So there is a fundamental justification for higher M&A activity and higher valuations in the short to medium term. Now, where we think there could be a slowdown or a stabilization is more on the valuation side than on the actual volume of deals and volume of M&A activities. That's where we stand, and where I guess the consensus is with the number of discussions that we have in the market. Couple of minutes left to wrap up. Really, I think that's all we have time for at this stage. Unfortunately, some of the questions that we unfortunately couldn't get to today, we will send through in the form of a digest to make sure that we respond to those. If you'd like to talk more about anything that we've discussed this afternoon or this morning, depending on where you're dialing in from, you'll see our contact details come up on your screen. I've got them on my screen now, so hopefully that's worked and it's come through. Today's webinar was recorded, so you'll all receive a link to that record and also the presentation come through to your email. There's a feedback link as well on the chat, so let us know your thoughts, any further questions that we would then put into the digest and add into those questions that we've that we've yet to respond to. And I think the last thing I'll say to wrap this up is many thanks to all of you for attending all these great questions, and we look forward to speaking to you all very soon. Thank you all.